Yeah, it's all about cash flow. I mean, it's great if you think you're going to make $5 million, but if you're losing money all along the way, I mean, it can bankrupt you. So you've got to have positive cash flow. And at the end of the day, if interest rates change, if asset valuations change, if cap rates go up, values go down, and you have to refinance, you're going to need income in order to do that. If you have, negative income, you're not going to be able to do anything with that property. First and foremost, cash refinance and HELOC are two different things. So HELOC is home equity line of credit. That's a line of credit. So that is something that you can draw when you need it, pay it back, and the interest only accrues as you take the money out. So that's a great tool to use to buy a property, and then you can pay the line back and you can just keep using it. They generally renew. Maybe it could be 3-year, 5-year HELOC, or it could be annual renewable. Business lines of credits, for those of you that have a business, a lot of people don't know this. You can go to your bank, and you should go to your bank and get a business line of credit put in place. Based on the revenues of your business. If you're doing $1 million, you should be able to get a $100,000 line of credit. If you're doing 5 million, 10 million, on from there, especially if you have net worth and assets. And that's an unsecured line of credit where you just sign for it. So if you don't have that, get that in place, because that's real handy to have for any of your companies and all of your companies, as well as credit cards as well for the company, so that you can, use those and get air miles and all that. So a HELOC is a great tool to have if you're going to, pull the money in and out. Cash out refinance is very different. That's where you actually refinance the property, you pull your equity out and use that to go buy another one. Excellent strategy, great way to do it, but the property still needs to cash flow at the end of the day. So if you refinance it to pull your equity out, you're only going to be able to pull out so much. You're only going to loan you, 80% generally. You're not going to necessarily pull all your equity out, but you might, depending on your basis. And then you can redeploy that, but the property still needs to cash flow at the end of the day. So that's how you do that. It's a great strategy. And, BRRRR is nothing new. It's, buy, renovate, rent, refinance, and repeat. So that's, something that's done and has been done for ages. And there's other ways to do it without having to refinance. So if you don't have the equity to refinance and you can't get a line of credit and all that, then you can raise the capital from other investors to do more deals, or you can do owner finance deals, lease options, and you can do master leases depending on the types of properties and things where, let's say Tenny has an apartment building, and Tenny could be anyone tonight, right? So Tenny has an apartment building that, he's just sick of, but doesn't want to sell it. So you can do a master lease and say, hey, Tenny, I'll lease your building from you for the next 40 years for $10,000 a month. And you get a steady check. You don't have to pay capital gains. You just get that $10,000 a month. Then you turn around and lease the apartment units out. And maybe you have a spread of 2, 3, 4, 5,000 a month. So you can do that on commercial. You can do that on multifamily. You can do it on rental houses, short-term rentals. It's very popular. They call it Airbnb arbitrage. That's not really arbitrage. Yeah. It's a master lease is what that is. But a lot of different ways that you can do the BRRRR strategy without a line of credit or without having to refinance. Oh yeah, every asset class all over the world. And it's because of the, quantitative easing, low interest rates. So yeah, all assets are in a bubble. We are going to see correction. We are going to see deflation at some point. I think everybody on here, if I polled everybody here and said, are you seeing inflation? I think every one of you would say yes. If I asked you if it's transitory, probably every one of you would say 80% of it's not transitory, meaning 20% of the inflation we're seeing right now probably won't be here after the pandemic. It's pandemic related, but car prices aren't going down. Food's not coming down. Gas isn't coming down. Housing costs aren't coming down. Taxes are going up. Insurance is going up. Clothing, I buy everything on sale. So, that doesn't really affect me, but, inflation is real. And as soon as the Fed pulls the foot off the gas of the bond purchases, which is keeping, mortgage-backed securities and bonds, which is keeping real estate interest rates low and interbank lending rates low artificially, those are going to start going up. So it's, it's a huge, huge problem that they're very aware of. They're not stupid. They know that they're in a corner and that they have to be very careful what they do and when. And I will say this, just for everybody listening, the biggest stock market crashes in the history of the world have all occurred in October, going all the way back to, what was it, the 1929 stock market crash. And then there was, a couple of them after that. And then 2008 and 9 financial crisis. It would all happen in October. And it was all a result of similar conditions that we're in now that created bubbles in assets. Make sure you have non-recourse debt, number one, if you can get it. Number two, make sure you pay attention to interest rates and what the Fed is doing, and be prepared for rates to rise, 2 or 3% over the next 3 or 4 years. They're not going to shoot up overnight exponentially like they've done in the past. The Fed is very aware. So the good news is they're going to let it deflate to a point, but they're not going to let it crash. They're not going to let the economy crash, because we're globally related now. For everybody who's watching, around the world, the United States economy is the leader. What the Fed does leads the world. The United States stock market leads the world. So they know that, and they're all talking. So nobody's going to let the world economy collapse, but they will let it deflate to a point. So you need to understand that if interest rates go up, your prices of your values of your assets are going to reduce exponentially. You need to understand your loan documents, that will trigger technical default, because if your property gets below a certain valuation, they can call the loan due. If your reserves change, in other words, the money you have in the bank, if it's not what you said it was when you got the loan, they can call your loan due. If the income on the property changes, they can call your loan due. So make sure you understand your loan covenants, what your loan documents say you are responsible for, what you are saying you're going to do and maintain, so that when and if a workout situation comes where values go up, interest rates go down, you can't refinance if you have shorter term debt. Obviously, long-term debt, especially right now, if you can lock in long-term debt, you're golden. But if you have short-term bridge debt or interest only, you need to be prepared for your interest rate to go up. You need to be prepared for your value to come down, because that's what happens. You need to understand what that does. What does a 0.5%, 1% increase in rates do to the value of your asset? And that's real easy to go back and look. What does it do to houses? What does it do to commercial? What does it do to multifamily? So you need to really understand that. To make sure that you understand how that affects the cap rates and how that affects the values of the properties, and then be prepared for it. And then again, if you do get into a workout situation with the bank where, something happens and your property is now worth less than what it was when you borrowed the money, and they're calling the loan, which they probably won't. They could, but generally they're not going to do that unless you're actually in default and rates have gone up and you can't service the debt. Then you need to get into a workout situation and rework the loan, and they'll do that.